In today's video, we are going to take a look at the consumer and beverage giant Coca Cola and evaluate if the company, which by many is so beloved, can still make millionaires like it has been doing in the past, as well as if they are actually a good investment at the current point of time. This is Might As Well Invest, becoming smart money. Coca Cola, which was founded in 1886, is not only one of the world's most famous non-alcoholic beverages, but also an absolute worldwide powerhouse and a titan of a consumer company. As one can imagine, a company of such scale most likely is worth quite a bit, and that is also the case for Coke, which as of today is valued at around about 226.2 billion US dollars. However, this does not only come from their position as a global market leader and can to some extent be attributed to their revenue of about 33 billion in their last fiscal year. To however get an understanding of what may drive Coke going forward, let's break that revenue down a little further. First of all, Coke divides their revenue into two key segments, the biggest one of these being the concentrate operations with about 18.5 billion. Just for clarification purposes, this includes the sale of syrups to Coke's bottling distributors as well as customers like McDonald's. This is then, last but not least, followed by the finished product operations, which contribute the missing 14.5 billion to Coke's total revenue. But enough with the brief introduction. Let's get to the interesting part for all of those who already are shareholders or want to become such, and that are obviously the distributions to shareholders. Coke currently returns capital to their shareholders through a dividend and to some extent stock buybacks, at least in the previous years. However, let's at first take a look at the dividend, which currently sits at about $1.68, equaling a current yield of 3.2%. Pair this with a dividend growth of 58 years and a fairly decent 5-year growth rate of 4.125%, and you get what can be considered a decent and growing cash flow. When it comes to stock buybacks, these are a little bit harder to track. However, it can be said that although they were present in the previous years, Coke did not run any stock buyback programs in 2020. This can most likely be attributed to them creating COVID provisions. However, let's take a look at the actual numbers in order to see how sustainable these distributions are and whether we might be able to observe a higher dividend growth in the future. First of all, we are able to observe a growing free cash flow, which even with minor hiccups still performs quite decently in the big picture. If we now put this into contrast with the distributions, it however has to be said that these are quite a bit higher than the free cash flow in every year except for 2019 and 2020. This indicates to us that the distributions look rather unsustainable in the long run, and a higher dividend CAGR is rather unlikely. But let's also take a look at Coke's balance sheet, in order to take a deeper look into the finances behind the company. As per usual, let's start out with the year of 2016, in which Coke's total assets sat at about 87.2 billion US dollars. These were made up by about 23.2 billion in equity, 45.7 billion in financial debt, and 18.3 billion in non-interest paying capital. But in order to be able to actually evaluate this even further later on, we want to calculate the net debt. This is obviously done using Coke's debt and its cash position of about 8.5 billion, with which we get a net debt of about 37.2 billion. If we now compare this to the year of 2020, we can see a rather small increase in total assets to about 87.2 billion. These were made up by about 21.2 billion in equity, 42.7 billion in financial debt, and 23.3 billion in non-interest paying capital. Let's however again calculate the net debt, like we did for the year of 2016 with this year's cash position of 6.7 billion. This time however we get a net debt of 36 billion, which is already a somewhat decent decrease. But let's also find out how sustainable the debt of Coke actually is and whether the debt has gotten more or less sustainable. This is done using the EBITDA, which after some basic calculations leaves us with a sustainability factor of 3.57 for the year of 2016 and 3.42 for the year of 2020. This indicates to us that the debt situation over at Coke actually got a little better. However, it has to be said that its debt position is already on the more unsustainable side of things. Alright, so since we now have the financials covered, what we want to do is get the margin of safety in order to determine our personal buy price later on. First of all, it is safe to say that Coke is what many truly consider to be an all-weather business. And in all honesty, you have to count me in on that statement. as I have to say that a company which has been raising its dividend for 58 years, as well as producing huge revenues throughout recessions and huge market downturns, has to be doing something right. Which in my opinion is not only the beverage itself, but also the brand behind it. Therefore, I'm going to reduce my margin of safety by about 5%. Secondly, I have to say that while Coke obviously is one of the most famous and also most beloved sodas, the Coca Cola company is actually more than Coke. Coca Cola owns and operates a huge portfolio of world-renowned beverage brands like Smart Water, Powerade, Innocent Smoothies, and a ton more. These are all brands that are market leaders in their industry that not only pull in tremendous amounts of customers and diversify Coke's portfolio, but that also sort of work as a future hedge against the declines of soda. That, according to the numbers, is quite a possible event in the future. However, it has to be said that the, in my opinion, upside of Coke doesn't stop there, as Coke, for example, also owns the coffee shop chain Costa Coffee, which especially in the UK pulls in even more customers with their non-beverage products that are mostly sold on a to-go basis in airports and train stations. Therefore, I will be reducing my margin of safety by another 10%. I, however, have to still say that Coke isn't an untouchable giant either, as it has to be said that the company is a rather mature business. Sure, this isn't necessarily anything bad, yet it has to be said that this forces Coke to rely heavily on acquisitions and emerging markets to perform well, so that they can keep on funding a growing dividend as well as future ventures. Therefore, I will be adding 5% to my margin of safety. What I, however, consider to be the biggest downside of Coke is more of a current affair. You might have already guessed it, it is our good old friend, the pandemic. As I've shown at the start of the analysis, Coke generates the majority of their revenue from the sales of syrup products to establishments like restaurants, bars, stadiums, and fast food locations. With these being shut down all over the globe, it is to be expected that there is a rather decent revenue decrease in that segment. Since travel, however, is also shut down, you can also add a decline in the to-go sales to that list, which makes it even more painful to me. Although this is most likely a rather temporary thing, I have to say that I'm still a little concerned, as I think insolvencies, especially in the restaurant industry, are likely to hit us rather soon, thereby also indirectly hitting Coke. Therefore, I will be adding 10% to my margin of safety. To now get the fair value of Coke, we have to take a look at the historic dividend yield. For the past 10 years, this sat at an average of 2.99%. Thereby meaning you want to buy the stock if the yield is above that. To put it into numbers, with the current dividend of $1.68, a fair price to pay would be $56.18, which would mean with the current share price of $52.21, you would be getting a 7.07% discount. If we now want to calculate the value I would pay for the stock, all we have to do is again get the average dividend yield of 2.99% and add my safety margin of 25%. This gives us our target yield of 3.73%, which leaves us with a price to buy the company at of $45.04. To sum it all up and answer our question from the start, whether Coke can still make millionaires, I would have to right away say, yes, the company can still make millionaires. However, don't get your hopes up that this will happen through crazy market gains, as Coke is quite mature and does not really bring that huge growth potential to the table. I still, however, have to say that if restaurants and so on should reopen rather quickly and go back to usual business, Coke might actually have a decent bump in the numbers, resulting in a nice gain. To, however, add it right away, I would at this point of time rate Coke a hold, as you can simply not really go wrong with the company if you buy it at a fair price.